interesting. There's a cycle, not a time cycle, but where that close is in the relationship to the range every day. The lower down you close, the more bullish the next day will be. The higher up you close, because you're extended, the more bearish or the opportunity for a decline tomorrow will be. So where the close is within the range, if you measure that over time periods, you'll see there's actually a cycle. Like, oh, we have a lot of low closes. Now we're going to have high closes. The market goes from low closes to high closes. That's an internal cycle of the market.
Do you believe in the traditional schools of thoughts within technical, whether it's Wyckoff theory, Elliott wave theory, the pattern traders? There's an abundance of strategies, and they're always evolving and new ones coming about. And you've probably in your time seen them all. Any of them that stood out to you as worthwhile?
Well, you're right. When I was lucky, when I started, there were only like 3 theories in the market. Now everybody's got a computer. Everybody's got a theory, right? So I don't know. The best way to prove a theory is with trading results. So show me trading results of Gann, Elliott wave, whatever the theory is. Show me some results. Somebody's actually doing it. I can't find it. So the other part is I have friends that are Elliott wave people, and they swear by it. They love it, whatever. I don't get it. Now, that doesn't mean it doesn't work. It means it doesn't work for me. I couldn't play basketball. I played football in college. I could never play basketball. I didn't have the skills to do that. So some people's minds process information differently, but I look at Elliott wave and I go, oh, all this stuff. My mind, I'm not that smart. I was so lucky that I didn't take business classes. I was always like not the smartest guy in the room, which means I never overthink things. I can't overthink things. All my intelligent friends that try to trade, they overthink everything and they make wrong errors. It's really good not to be too smart, because you don't overthink anything. It's like it's right in front of you. That's what it is. They're always overthinking everything.
There's kind of 2 sides of the spectrum here, where one side would be every strategy works, you just have to make it work. And then the other side that I see is every strategy works sometimes, and that's the key, where let's say you have a broken clock. At 6 o'clock is correct, 6 a.m., 6 p.m. The rest of the day is not correct. And people say that a lot of these strategies work sometime to get people involved in the market and ever losing. Do you believe it's one side or the other?
No, I think you just have to respond to what's going on. The markets are imperfect, and people try to think it is perfect. That's the problem. I've had a lot of people with deep mathematical backgrounds come to the market and totally blow up. They're trying to use math, which is perfect, on an imperfect thing, and you can't make what's imperfect perfect. Another really good analogy, I played football in college, as I mentioned. Well, every play in American football is designed to score. If this guy blocks this guy blocks that guy, the guy with the ball will score. Well, but they don't score in every play, right? That's reality. Somebody else changes the perfect play. And that's kind of like the market. Every trade I put on should be a big winner. It isn't. So, like Mike Tyson said it best. He said, everybody has a game plan until they get punched in the face. And it's like, the market's going to punch you in the face a lot more than Mike Tyson will.
Going off this sports analogy, you know, at the start of the game, you have a play in mind, and maybe it's going well, and then something happens that you couldn't forecast. And I see this with the markets, where today I make a decision based on all the information I have, technical and fundamental, and then as weeks go on, things change, and now what was once correct is no longer correct. Kind of linking here to time horizons, where the longer you hold a trade, the more things that can happen in between, and therefore the degree of certainty could go down compared to someone who's holding a trade for an hour or two. What is your beliefs? Because I know you are a swing trader or a long-term hold. With this degree of uncertainty, why not choose to be on the intraday timeframes?
The problem with intraday time trading is purely mathematical. You stop to think about all profits in the market are the basis of trend. If we don't have a trend, you're not going to make any money. It doesn't matter if it's real estate or stocks, what, it doesn't matter. You have to have trend. So, what's the function of trend? Time. So a day trader can be in a trade for 4 hours. He can't catch any big trend move. I can be in a trade for 10 days, 12 days, a month, 6 months. I can catch a huge trend move. So I have time is on my side. It's an ally. I can capture trend moves. The only way that when I did a lot of short-term trading, if I made a lot of money in a day, I had to risk a lot. If I want to make $10,000 in a trade today, I've got to have on, I don't know, 5, 6, 7 contracts. So if you risk a lot, you can lose a lot. Whereas my trading, if I have a small position and catch a big move, I can have a lot of little losses and still catch that one big move. I'm way ahead of the game. So it's really, there's an interesting report I just saw over the weekend of all the successful strategies that are around. Though in real-time performance, the ones that made the most money have the lowest percent of accuracy. The ones that that had the least gains had the highest percentage of accuracy. So they got what everybody wants, like, oh, I won. But you didn't win very much. And when you lost a lot. So really a tremendous insight there into the markets.
Let's take a moment. Your win rate or accuracy rate is not as important as your risk to reward per trade.
Well, clearly, I'll show you a system that wins 95% of the time and loses money. Because you had 95 winning trades, looks great, and then you have 5 trades that blow up and lose everything that you had. So, yeah, winning is important because we all like to be stroked and feel like I'm doing something good here. It's hard to be right 30% of the time, which a lot of the trend followers are. I want to be more correct than that for myself. But we're hardwired to be right. Dead right, unfortunately, usually.
I think that gets into ego and other things, which I want to touch on later. I want to bring this to the COT report, and probably you were one of the first people utilizing the COT report.
I was the first.
Actually.
The very first.
Before it was a digital thing that we could all access, it was probably shipped to your house and so forth, and a completely different process. Nonetheless, I've spoken to a lot of traders now that are utilizing the COT report as their primary source of information. And the general consensus that people use it with is understanding what the big players are doing to identify a trend and then become trend followers, and bringing in this belief of self-fulfilling, that if the big players are all buying with serious money, the market must go up. It seems your approach is more contrarian to this. So first of all, this premise that most people follow, would you agree with it?
Well, let's go back to the very beginning. Most people don't understand the COT report. It's a report that's issued every week through Tuesday, so we know through Tuesday's action what 3 players in the market did. The small traders, little people, if you will, the institutionals, the fund managers, and finally the commercials. Well, what's a commercial? That's the critical point. A commercial is defined as a user or producer, a hedger. So the hedgers are not buying the commodity. They're hedging it for their business purposes. So you'll see a big decline in the market, and the commercials steadily increase their long position. But they're doing that because they're going to take this product in demand, take it and make buy a lot of sugar. If they can buy sugar lower now than yesterday and lower next week than today, their candy bar, which will still sell for $5 a candy bar, their cost of production is a lot lower. So they will buy a lot of weakness because they're actually taking the sugar, cocoa, gold, whatever it is, their cost of production is lower. So they'll accumulate. So you need to think that they are accumulators. They're not trying to time the market. So COT is not a timing mechanism. It's a condition that says, oh, these guys are heavily long or these guys are heavily short. We're probably in the area of a rally or decline. Doesn't mean it's going to happen today. That's when technical analysis comes in. But it's a setup. And you need to really look at these 3 parties. And in some markets, as we mentioned, like in hogs and cattle, the small traders are really good. They're as good as the commercials. In fact, they almost parallel what the commercials are doing. So you need to understand the markets as well.
Is the appropriate use of the COT report to use it as almost a leading indicator to forecast what should happen?
I'd say a suggestive indicator that when and it's not the only condition that I use, but if I have 3 or 4 conditions, I like valuation, I like commitment traders, I'd like seasonality, I like cycles, I like accumulation. If I had a bunch of things, then markets, I got a lot better chances of market rallying. So I would never rely on say this one indicator is it. There's no one path to heaven, and so it's one of the tools that I use. It's a good tool, but it's not a be-all, end-all tool.
So, of course, a lot of people use the COT report, and I've spoken to a bunch of them, but I don't think anybody is utilizing open positions in alongside, whereas it seems like that was a cornerstone of what you did. Can you explain the relationships of the two and how you benefited by using both?
Well, we talked about the three elements of the market: short-term traders, fund managers, and commercials. There's another aspect, which is total open interest. That's all the contracts that are open today. So if there's a lot of contracts open, somebody's been doing a lot of buying or selling. What's been going on? So, and if you just look at any chart, you don't take my word for this stuff. Let the charts teach you. Whenever open interest is really high, we're most always at a significant high point in the market because a lot of interest, everybody's in the market. And when everybody's in the market, there's nobody left to buy, right? So the markets come down. So I want to look and see who drove open interest up. If the big increase in open interest is caused by the commercials, well, that's bullish. But if the big increase in open interest is caused by the small speculators, who are usually wrong, well, that's very bearish. So open interest is really helpful. I kind of pull it apart and say, who's driving this market now? Who's causing the action? I love to see open interest going way up, public way up there buying, and commercials are getting out of the market. That's what's happening in gold right now. Gold's going to come in and start to come down. There's a condition here. The commercials ultimately are going to be the winners. It might take time, though, why you need to use technical analysis.
So here it seems that you're utilizing a few confluences together to then be not the trend is your friend and go with the big moves. It's rather wait for the big move to happen and then look for a catalyst to get the mean reversion.
Yeah, the way I sum that up the best, people, whenever I lecture, well, what's the favorite market? What market do you like to trade? What's the best market to trade? Like, man, if I got $1 for every time I heard that, I wouldn't have to trade. Here's the best market to trade. The one that's set up the most right now, today. It might be gold now. It might be silver next week. It might be potato chips. Who knows? But I don't have a love affair with any market. I'm looking for a market that has cycles, seasonals, commitment to trade report, accumulation going on, a little bit of trend change in it. That's the market I want to trade. There's no be-all one market. There's no be-all one indicator. So I'm shopping every weekend. Most of my trading time my research time is on Saturday morning. Okay. I go through all the markets. I make a list every Saturday. These markets are set up to rally. These markets set up to decline. Then, on a weekly chart, then I go to the daily chart and say, okay, where are we trend-wise? Can I get a trend change here, significant trend change? Where would that be? Then I can place a trade.
So building these things together, I just want to bounce off repeat what you said. We're looking for outsized opportunities, risk-reward potential. So you will then use the COT and open positions to find a crowded market where everybody is on one side and you just need a catalyst to then go the other way. And then you bring in accumulation, which is you're sensing this behavior shifting. How do you read or define an accumulation?
Well, I would bring in accumulation. Commercials buy and sell stocks or commodities different than the public does.
Okay.
So years ago, maybe 35 years ago, after I said I was the first guy to use the Commitment Trader Report, I started to realize the buying pattern of these people. So by analyzing their 18 relationship between today's open, high, low, close and tomorrow's open, high, low, close, I can analyze those relationships and pick out what the commercials were most likely doing. So I have a synthetic index that will measure when they're accumulating in the market. But that's just one tool again. But I still would want to bring in valuation. My valuation model is just like, it's not a timing tool, but boy, markets get overvalued and undervalued, and that's when you really want to step in if the commercials are there and accumulation is there. I mean, it's kind of boring. You have to wait for all this stuff. Everyone's buy, sell, I want to sit back. I've had, I don't know how many millions of trades in my life. I don't need more trades. I want a good trade. I want a big trade, and that's patience.
So here we're not actually referring to accumulation through a technical perspective, let's say a Wyckoff perspective of a zone of consolidation before a market expansion. Are you referring it to more these?
Well, you could use that if you had a market that was conditionally set up. Let's say fundamentally set up.
Yes. Then
you could bring in Wyckoff or waves or astrology or, just throw a dart on a dartboard, whatever. Then you could do any of that stuff. But again, this is my core belief. Could be wrong. But my core belief is markets move for reasons. They go from here to here because of a reason. So I've got to have the reason here. Then you can bring in Ouija boards if you want to do your timing in the marketplace. But to me, the markets are so conditional that I want to start with a condition that I probably should rally, then bring in all the mumbo jumbo of technical analysis.
Why do you think that, at least in my generation of traders, everybody looks towards technicals pretty much only, and all the resources, and spend all their time on technicals, whereas for you it seems like a bit of an afterthought? It's just for execution, and anyone will do. It's more about the positioning in the market and the setup first, and then execution later.
Oh, I remember when I was young once and had those same thoughts. It was all technical analysis. And that, it was just like, well, think it through. Just think about it. Markets move because of charts? No, charts don't move markets. There's got to be a reason why these things move. So, and the other reason why, when I was young, I was really into charts, and young people are now, and young people 100 years from now will be as well. It's easy. I was like, oh, I can read a chart. Well, I can't read Hebrew. I can read English a little bit, but it's a whole new language. There is a way to read charts. My friend Tom DeMarco has done a great job of breaking that down into structure. And charts are readable, but they don't tell you the magnitude of the move that's going to come. They just say we're at a high or a low. So the magnitude, again, I think comes from conditions. Some of those fundamental conditions, some are technical conditions. But the market's got to be conditional for me to really want to get involved in a big way.
For the last 2 years. So naturally, when you are looking for these outsized returns and you're going against the majority consensus, it all makes sense in theory. But the first alarm bell that rings in my mind is, how do you stop getting bulldozed or catching a falling knife? Because of that famous saying of the markets can remain irrational longer than you can remain solvent. Do you not fear that you're picking tops and bottoms here?
Oh, I don't try to pick tops and bottoms. I'll leave that for the younger people to do. I just want to try to get a chunk out of the markets. Maybe I'll be close to a low. I don't know how many trades I've had in my life, 10 million. I think I got the low at markets twice. Just throwing darts, I should have done better than that. So it's an impossibility. I'm not going to try to catch the low. And people who say they do, they maybe got one, they'll brag about it, but there's no consistency in that. There's no truth in that. So I just want to try to get a move in the marketplace. And precise timing, I don't know how to do it. I'm just not smart enough to do that.
It seems your beliefs on risk are pretty different. I want to first speak about the World Cup performance and how you risked there, and then in general in your career, how you risked. But what is your relationship like to risk, and is there something that would be one of the more important factors, considering win rates is probably not that important?
Well, without risk, there's no reward. So the greater the reward, the greater the risk. And the problem with that is, if you're going to have that high exposure risk, you got to be really accurate. And if you're not really accurate, you're going to blow up in a hurry. So if you're going to maximize your risk, and there's Ralph Vince has written about the optimal F, there's an optimal risk that you should have, but you're so close to disaster that it probably isn't good for most people. And there's also the emotional aspect of it, is that, yeah, I can lose 30% of my account in one trade. Most people can't do that. They can't emotionally handle losing a third of their wealth in one trade. I'm not smart enough to worry about it, I guess. Being Norwegian helps a lot. Sometimes they're a little slow. But you have to find your risk point where you can risk that and still not go crazy. As I mentioned, I've had 6 friends commit suicide in this business. One of them, the last one, didn't risk all that much money, but to him it was. And he had a success of losing trades. He thought he just couldn't handle the losses. And the last one was in a soybean trade. He hadn't lost all that much money, but he found a shotgun. So while there's an optimal amount of money you should risk on a trade, irrelevant. What risk can you handle? At which point can you go to sleep, wake up once or twice during the night? That's fine. But if you can't sleep at night, then you're risking too much.
Would you say this is a factor of nature or nurture, the tolerance to risk?
Well, I don't know, but some people can handle more risk. Some people are more emotional than other people. So that's where you have to kind of plumb the depth of your soul and find out at what point can I really handle this stuff.
Were you someone that was always head on towards risk and could stomach it, or is this a muscle you've trained?
Well, I don't know if it's like you can stomach it. It's like some of us have so much belief in that things will work out. Optimism, God will prevail, whatever. So I've been in a lot of problems in my life, but I've never worried about it. I'll get out of this. So, but some people worry about everything. Oh, it's going to rain today. Well, it's a beautiful day. Well, it could rain today. I can't go out today. They worry about everything. Well, they're not going to be very good traders. They're too emotional. So there's some balance point in there where you go, I always thought my life would work out. I grew up in Montana, and I learned to live off the land. I mean, I could walk out in Montana and live the rest of my life in a cave someplace. I know how to survive living off the land. So ultimately, I don't have any fear of life. There's no fear of, I die, whatever, okay. But I can survive. A country boy can survive. And so why not risk something? Let's see what happens here.
There's beauty in the irony that the more willing you are to go back to zero, the more likely it works out, because then you can actually stomach the risk and see and hold trades for long enough to see them to their potential.
Yeah, I think as I've gotten older, now that I'm 83, I don't risk as much as I used to. I don't have to risk as much as I used to. And I don't have the energy. I saw Frank Sinatra's last concert. He wasn't that good. I saw Muhammad Ali's last fight. It wasn't that good. I saw Tom Brady's last football game. I saw Bob Dylan, a horrible concert now. So I know at some point, just because of my age, I have to say, wait a minute. Think of Frank Sinatra. He was way off key. People loved him. He was great. But, he didn't sing real well.
Are you alluding here to ending your trading career whilst you're on top?
Well, I don't know if I've ever been on top. I know I have friends that have been really on top. But, yeah, you want to walk off the stage ahead. I'll still do some things publicly. If you can control the event at my age, that probably will work. But to just keep trying to just pedal to the metal all the time, I don't have the fire. I don't have the burn anymore. You got to have a real burn to do this stuff.
The reason I say this is because I watched an interview of yours about a year ago with Jason Shapiro, and you were mentioning that maybe this is the year that you will retire.
Yeah, I've been trying to retire for a long time. I first tried when I was 30. I made $1 million trading. Oh, great. Tried to retire. After about 4 weeks, I had a nice cabin in Montana. I went out fishing every day. Finally, the fish go, you caught me yesterday, put me back. It was like, okay, catch a fish, put it back. I was like, I got bored. I got, what else am I going to do? And kind of now, I pulled way back. I was like, well, I don't garden, I don't build things. All I know is how to trade. So I still need some involvement in it, but the pressures, from 1962 forward, every day of my life has been about the markets, up, down. And there are pressures to that.
Is this a now intellectual thing or a challenge, or is it still the monetary side?
Well, money always matters. You never have enough money. I was flying back from London one time with a lady who was a housekeeper for the Rothschilds. And we were talking, we were first class, of course, and she said, Rothschild, and I said, oh, wow. Because I know they were all political conspiracies and everything. She said, oh, they hate politicians. And I said, what's it like? You're grateful. Oh, look, the refrigerator hardly ever has anything in it. People don't realize how they live. I was like, well, that was a wake-up call. I mean, I have a friend who's very incredibly wealthy, a multi-billionaire. He's still trying to make money. At some point, I said, you know what? I'm happy where I am. And I don't want to build anymore. That's for people that have more energy. My desires right now, figure out more about how the markets really work in terms of cycles and maybe some trend stuff I'm working on. So I still do a lot of research, and still trading, but hopefully somebody's going to crack this nut of the market. We all try to. Maybe I won't, but it's a heck of a challenge.
What do you mean by cycles? Are we talking just accumulation, expansion, or seasonality?
Well, there's a lot of cycles in the market. There's the cycle we mentioned, closing on lows, closing on highs. That's your natural cycle. Another natural cycle a lot of people don't see is that we go from large ranges to small ranges. And then we have large range, we have small range. So I like to see a lot of small ranges because then we'll have large ranges where the money's made. So that's a cycle of how prices trade. Then there's a time cycle, high here, low here, high 18 days, 33 days, whatever. So the time cycles as well. And I think on a very long-term basis, there is some predetermined time cycles in the market that will have been here, we know, 100 years now. The 3.5-year cycle that Edgar Lawrence Smith wrote about almost 100 years ago still operates in the marketplace. So trying to crack that code that's a real challenge. So I have the time to do it now.
That side of things gets a little bit freaky, and also like we're entering a weird arena, numerology and astrology in the markets. My initial reaction when I first came across these things was like, hell no, that can't be real. And then as I speak to more elder traders specifically, they are more into this belief. I remember sharing the story with you previously on a guy that I know in Dubai who's one of the wealthiest guys there. He has one of the most expensive houses in a private island in Dubai, and he made his money in textiles and then has been trading for like 8-9 years. And his strategy is he has his 8 gurus from his religion, and if they all give an alignment based on astrology, he will then take a trade. And I had 1,000,001 questions for him, and eventually he was like, son, I don't know why it works, but I've got an 8-year track record and I beat the market every year, and this is what I do, astrology. Numerology and kind of predetermined, as you said. Can you hazard a guess of what do you think is going on here?
Well, I have a similar experience. When I first went to India, somebody said, well, I got introduced to the largest private trader in India. I said, how's he doing? He said, well, I don't know, but he changed his ring because the rings had jewels on them. And if your luck is good, I guess you move your ring around. If it's not good, so he had moved his ring. The jewels were in a different position. And you have to find the shoe that fits you. Some people can use astrology. Some people can use Elliott wave. Some people can use point and figure. Some, I don't know. Some people use maybe the Community Trader Report. But you have to find what fits you. And that's the interesting point, because if you're looking for a good teacher, don't go to necessarily the best guy or girl. Go to the person who you understand. You immediately get his concept. That's your guru, if you will. If you say, I don't understand this, well, don't let him teach you. You're not going to learn from him because you don't immediately grasp his message. Mm-hmm. So you need to find somebody whose work is, I see the sense of this. I see the logic in the way this person thinks. So that's significant. But I do think that there are emotional cycles of humanity, whether they're caused by the moon or Saturn. Or there's a paper by the University of Michigan, one by the Federal Reserve System, that shows there's clearly a lunar influence to stock prices. Mm. Now, it's not large enough to make any money trading it, but and throughout the world, all major stock markets in the world have a lunar influence, but it's very nominal. Okay. Now, maybe somebody that's a really great astrologer can take that to another level, or a lunar person or whatever, that I don't know. But, the way I look at this is like when I used to fight, when I used to box, you go in the ring and you're going to throw any punch you can. You're going to use any advantage you have. And that's in the markets. I mean, I'm in trades right now and I probably did some things that are rational, but they're based on things in my mind that I may not even recognize. But this is a fight in there. You're going to protect yourself at all times. Like, what's going on here? Mm-hmm. So whatever works for you works.
A lot of these strategies, they seem they're built on correlations. For example, let's say a basic Fibonacci, where you have if you were to measure 1,000 impulses and pullbacks, and you measure the depth of every pullback, some of them would be a 99% pullback, some of them would be a very shallow 1% pullback, but the majority would be around the midline, and you'll get a normal distribution. And therefore, it's not that the market is reversing because of the Fibonacci. Rather, the Fibonacci showcases a probabilistic zone. And you could do that with patterns, you could do that with a wave count, you could do that with pretty much every technical strategy. Is therefore looking for correlations an appropriate approach, or should we be looking for some truth and some causation in the market?
Well, first of all, I did the studies where we measured all the pullbacks in the Dow Jones Industrial Average for like 7-year time period to see which percentage was hit the most, 50%, 38%,